Most people think stocks are something complex, technical, and only for people who already have money. But in reality, stocks are one of the simplest concepts in finance. A stock is just a piece of ownership in a company. When you buy a stock, you are no longer just a customer of that business. You become a partial owner. You own a tiny fraction of its future, its profits, its failures, and its success. That's why stocks are also called equities, because you now have equity in something real. Not numbers on a screen, not imaginary assets, real companies, real employees, real products, real money being generated every day. People invest in stocks for three main reasons. First, capital appreciation, which means the stock becomes more valuable over time. You buy it at one price, and years later it's worth much more. Second, dividends, which are portions of the company's profits distributed to shareholders. It's basically passive income generated by businesses you don't even work for. And third, control. Some stocks give you voting rights, meaning you can influence decisions inside the company, even if it's just in a symbolic way. Companies sell stocks because they need money, not because they're generous. They use that money to pay debts, launch new products, expand to new countries, hire more people, or build new facilities. Instead of borrowing from banks and paying interest, they sell ownership to the public, and in exchange, investors share both the risk and the reward. But not all stocks are the same. There are two main types, common and preferred. Common stock is what most people own. It usually gives you voting rights and the chance to receive dividends, but you're also the last in line if the company fails. If everything collapses, common shareholders are the ones who get whatever is left, and sometimes there is nothing left. Preferred stock is different. You usually don't get voting rights, but you receive dividends before common shareholders. And if the company goes bankrupt, preferred shareholders get paid before common ones. So you sacrifice control for more security. Beyond that, stocks can also be categorized by behavior. Growth stocks are companies that grow faster than the average market. They usually reinvest all profits instead of paying dividends. Investors buy them because they believe the company will be much bigger in the future. These are high risk, high potential. Tech startups, innovative companies, disruptive businesses. Income stocks are the opposite. These are stable companies that pay consistent dividends. Investors buy them not for excitement, but for predictable cash flow. Utilities, banks, and established corporations fall into this category. Value stocks are companies that appear cheap compared to their earnings. Their price-to-earnings ratio is low, meaning you're paying less for each dollar of profit. Sometimes they are cheap because the market is scared, bored, or simply not paying attention. Value investors believe the market has overreacted and that the price will eventually rebound. Blue chip stocks are the giants, big names, strong brands, decades of history. These companies survived wars, crises, bubbles, and recessions. They usually pay dividends and are considered safer, not because they can't fail, but because they've already proven resilience. Stocks can also be classified by company size. Large cap stocks are massive corporations. Mid cap are medium-sized companies. Small cap are younger, riskier, but often with higher growth potential. Then there are micro caps and penny stocks. These are extremely small companies, often with little or no profits, very volatile and highly speculative. Penny stocks rarely pay dividends and are closer to gambling than investing. Now, let's talk about the truth most people ignore. Stocks offer the greatest potential for long-term growth of any mainstream investment. Over long periods like 15 or 20 years, stocks have historically outperformed almost everything else. But that doesn't mean they're safe. Stock prices go up and down constantly, sometimes for logical reasons, sometimes for pure fear. Sometimes for hype, sometimes for no clear reason at all. You can lose money, a lot of money. And if a company goes bankrupt, common shareholders are literally the last people to get paid. Even strong companies lose value. On average, large stocks lose money about 1 out of every 3 years. That means if you panic and sell during bad periods, you lock in losses. Not because the company failed, but because your emotions took control. This is where most people fail. Not because they don't understand stocks, but because they don't understand themselves. They buy when everyone is excited. They sell when everyone is scared. They check prices every day. They react emotionally to short-term noise. And then they blame the market for their own behavior. Market fluctuations are normal. A stock's price can be affected by internal problems like bad management or external events like politics, interest rates, wars, or crises. None of that means the system is broken. It means uncertainty is part of the game. That's why stocks are usually only one part of a portfolio. Younger investors can afford more risk because they have time. Older investors usually shift to safer assets like bonds. Diversification exists to protect you from yourself. It spreads risk so one bad decision doesn't destroy everything. Buying stocks is easy today.
You can buy directly from companies, reinvest dividends automatically, use discount brokers, full-service brokers, or stock funds that invest in hundreds of companies at once. But no matter how you buy, fees always exist. Brokers charge commissions. Funds charge management fees. Full-service brokers charge more but offer advice. Discount brokers are cheaper, but you're on your own. Every fee reduces your long-term returns, even if it looks small. And then there's fraud. Public companies must register with regulators and publish reports. You can find real data on systems like the SEC's EDGAR. If information is hidden, vague, or impossible to verify, that's not an opportunity. That's a red flag. But here's the real psychological trap. Most people don't lose money in stocks because of bad investments. They lose because they never start. They stay in cash forever. They wait for perfect timing. They feel not ready yet for years. And while they wait, inflation quietly eats their purchasing power. Their money loses value every single year. They think avoiding risk keeps them safe. But in reality, avoiding growth is the biggest risk of all. Because the real purpose of stocks is not getting rich. It's not beating the market. It's not bragging about returns. It's escaping dependency. Dependency on salaries, dependency on governments, dependency on luck, dependency on other people's decisions. Stocks shift you from consumer to owner, from employee to participant, from reactive to strategic. And that shift is not financial, it's behavioral. The moment you start investing, you're forced to think long-term. You're forced to control emotions. You're forced to delay gratification. You're forced to stop thinking in months and start thinking in decades. And that alone already puts you ahead of most people, not because you're smarter, but because you stopped letting fear decide your future.
If you watched this entire video, here's what that means. You're not just curious about stocks, you're thinking about ownership. And that's different. Most people stay consumers their entire lives. They consume products, consume content, consume salaries, consume trends. Very few decide to own. And that decision, even before the money, changes you. Because investing forces you to grow up financially. It forces you to think long-term. It forces you to control your emotions when prices fall. It forces you to stay calm when everyone else panics. And that's not a financial skill. That's a behavioral one. If you're serious about shifting from consumer to owner, from reactive to strategic, from salary dependent to asset building, then don't let this just be another video you watched. Take one small action. Open the account. Read one annual report. Define one investing goal. Start with something. Because clarity without action becomes regret. And years from now, you won't regret the volatility. You'll regret the time you lost waiting. If you want more videos that break down money, investing, and psychology in a simple, real way, subscribe to Money Behavior. This channel isn't about hype. It's about thinking clearly in a noisy world. Comment below. Are you still on the sidelines, or are you ready to become an owner? The difference between those who build wealth and those who don't is who decides to start. I'll see you in the next one.